Oops, we're live now. There we go. Everyone jump, LA Fintech, we're going live. Looking good. All right, everyone, thanks a lot for coming down. So we're going to have to go a little quieter right now so that we can hear everyone speaking.
Do you want me to yell at the whole crowd?
We're going to have to lower it down a little bit. We have to lower it down. And so thanks a lot for coming down. We've got a really great panel here tonight. And so these are some of the local LA angel, VC, different types of investors that invest in the fintech area. So thanks a lot for coming down. And I think this is going to be pretty, a lot of information coming out where a lot of you that are in startups, looking around for different types of investors or just learning about the fintech side. These people here have a lot of insight in the fintech space, especially with their experience. So let's get it going now. Woo! Yeah! Woo! So I just wanted to ask some of you guys, gals, a little bit about your background and what got you into the fintech space. So if anyone opens up and talk, but just kind of give us a little bit about your background and then how you kind of got into the fintech space.
Thanks,
Sounds good. So, in terms of my background, actually, I'm not from the U.S. I was born and raised in Ecuador, and I came to U.S. for college, went to school in Philadelphia at Penn, and then I spent my first years after college doing investment banking at J.P. Morgan. I was focusing on mergers and acquisitions in Latin America. And after that, I decided to switch internally to work at a fintech team at JP, actually, in the innovation branch. I was very, very excited about learning how they were doing it. And then I realized it wasn't really that exciting after a year in the job. It was much more slow-paced than the vibe you get at a smaller firm. And so I decided to make the jump to venture to the investing side. Always in fintech. I'm very passionate about the industry. And I moved to LA almost a year ago. I joined Clocktower Ventures. I'm part of the investment team there.
So, I am from the Bay Area, not LA. Extended LA came. I go with the guy from the Bay Area, but for now it's different. I got a PhD from Stanford in 2014. At the same time, I left Google and the Federal Reserve. After became IPO, then left Federal Reserve by 01 and then started busy finding the next capital with my friend from Google. And we invest in Fintech and other very early stage startups from Stanford and Berkeley where we're both from.
Yeah, I was originally a physicist. I switched into finance, derivatives modeling, and quantitative portfolios. I've been doing that for about 15 years. About 5 years ago, maybe 6 years ago, I was getting interested in angel investing. I joined Pasadena Angels, been investing in companies for the last 5 years. And since my background is finance, I tend to gravitate towards fintech.
So I'm Rob. Like you, I'm not from this country. I'm originally from the UK. I've been on sides of this dice that you're in right now. So my first role was that I was a fintech entrepreneur in the UK, and I built a startup within Lloyds Bank, which is one of Europe's biggest banks, which allowed brands to sell white label financial products under their own brand with no financial experience at all. So I was 26 when I did that, and that generated about $130 million in revenue. And then when I was sent over here, I was also buying software at the time as well, so that's the second side of that dice. And then I was sent over here in 2010 to run the North America region for Lloyds, and I wasn't a very good corporate employee. Felt kind of bored, and I became an angel investor, and then I finally became a VC after I had a pretty good run of being an angel investor. So I invest, my firm, we're on our third fund right now, we're investing out of a $75 million fund, and our check size is about 800 to 2.3 million in total for the total investment that we make. But we invest in B2B software, and typically founders who are solving hard problems that matter. So we're not an impact fund, but we invest in stuff that does good for humanity. After 6 years of searching, I made my very first fintech investment about 6 months ago, which I'm very proud of. I kind of come from a world of managing compliance, which is scary.
Hi everyone, my name is Garrett Gilbertson. I am the now newly appointed chair for the Band of Angels LA. If any of you are familiar with the Band of Angels up in San Francisco, they've been around for about 25 years. One of the oldest angel groups out of the Bay Area and Silicon Valley. And over the past, well, I guess I should backtrack real quick. My background is former Air Force officer turned entrepreneur, and then I ran a family office up by Caltech, and then did a little bit of consulting work for a minute, and then had the opportunity to run a corporate VC down in Newport Beach. It was a seed stage, it was industry agnostic, but we have done fintech deals, I've done fintech deals, and then decided to go do my own angel investing. And by virtue of bringing up great companies from LA up to the Bay Area, the band, which has never expanded really outside, said, you know what, we're going to take a bet and try to get our members together down in LA. So I'm here, kind of representing them, and also representing my company, Startup Mavericks, and we, do some early stage investing as well as advising a portfolio, like our portfolio companies. Recent investment is Unest. I think that past the Angels, we had Stender invested in Unest, was a company that I found, host a monthly pitch event, and Unest was a great fintech convention to talk about some of our bets. Just excited about the opportunity to be here with all of you. So.
Hi, everybody. My name is Dave Lynn. I'm with Unicorn Venture Partners. My background is actually in investment banking, which partially explains why I have this affinity towards fintech that I can't seem to run away from. I was at Upfront Ventures. I was the founding CFO of Maker Studios, a few other local startups, and then ultimately decided to start this fund with John, who's actually in the crowd here. We're called a unicorn, I guess, for the obvious reasons that we like to invest in companies that are really fun for moonshots, but also because of how we're structured. Our focus is broadly in tech and consumer, and genuinely pretty equally split between the two areas, but also because a lot of our positioning around who we get capital from is a lot of billion-dollar family offices, and we almost act as an extension of their office, where we have a relatively smaller size fund that we make investments out of, but our LPs will commonly come in and do 10 to 20 times our investment. Our investments include Bitmain, Coinbase, at least in the fintech space. Some derivatives of that as you go up kind of the applied areas of fintech, like HomeLister, that is focused on essentially a financial transaction wrapped around real estate tech. We've been very eagerly trying to get a complete de novo team in the blockchain space that's focused on decentralized database software for different blockchain applications up and running. So we will go from idea stage all the way to a later stage company that is able to kind of generate a IRR that we're targeting, a venture style IRR. So that's it.
Cool, thanks a lot. So what are some of the characteristics or things that you particularly look for in a startup, like your top 3 things of what some type of fintech company should essentially have for you to like look at them, or kind of get involved with them at an early stage or even a later stage? Like, I'm sure some of these people would be interested, like being like, okay, I'm gonna be prepared in 6 months from now, a year, of certain characteristics that you are kind of interested in. So anyone can start it out.
So, I guess I can go first, just so that I sound original. So at the risk of not sounding original, I'll go first. I think you're going to get different answers from everybody in this crowd, right? And I think it's important as you kind of process what maybe each of our perspectives are, that you think about kind of where we come from, right? Part of why I share my background, probably part of what's valuable about how everyone shares their background, is you're very much a byproduct of your training and your experiences. So I came from an institutional venture capital firm in Upfront, and we had a very sort of strict, rigorous process. As much as I will say it's a strict institutional, rigorous process, we were also not necessarily focused with tech investors. We were a large generalist fund, right? One of the larger funds in California, and as a result, we had to look at everything. And so we stumbled into a lot of fintech, and when I started off in venture, venture was still started by finance people, because they were the only people who know how to set up the funds. Now you see people who kind of come out of these different companies and they look at different things, and they're more from the entrepreneurial side, and they've got kind of a balance sheet that they can deploy. So with that in mind, I mean, what we look for is very cookie cutter institutional type of stuff, right? We follow a theme. That theme is generally based upon some big thesis of changing, access to finance, or whether you're going for an unbanked versus banked approach, whatever. You've probably heard some of these things. Outside of that thematic layer, it's pretty cookie cutter, right? We look for a good team. We make sure that the timing is right, that the idea and the timing of that idea is right. And then the last thing we really value is whether that company, that team, that whole story is financeable. Because we don't want to be orphaned in a company, regardless of how great the team is and how great the idea and the timing of that idea is. We need to make sure that the team is able to raise more money on top of it, whether it be with our help or without it.
To build on that point, I guess from more of an angel perspective, when I'm looking at a seed stage investment, I would say that everything you said is true. However, we're much more, you'll see across the board that one thing most angels have in common is they're much more founder focused. At the end of the day, you have somebody in the room with you, or a group of people in the room with you, who are cutting a check from their own personal account, and they are going to need to believe in you as the jockey, and going to need to believe that you have better domain expertise oftentimes than they do in your specific vertical. So it's incumbent upon you to convince them that you are the right person and you have the right passion in order to lead your project through, to exit. Now, to his point though about not wanting to be the only person, writing a check, we're seeing a trend here that there's larger dollar amounts going into fewer companies, right? And so it's becoming pretty clear that there are a lot of companies that are, even though they've had some early success, they're coming back to us and saying, you know what, we need a seed extension, we need a bridge to get to our Series A. So one of the things that we look for in a founder is I want to understand that you know what KPIs you're tracking that are going to attract your Series A investor, and that even though you're maybe raising a seed round right now, that you've already begun those conversations with those Series A investors. And I can pick up the phone and say, hey, do you agree that this is addressing that there's a real market, a large market out here, and that they have a nuanced solution to this market, so that if they hit these KPIs, that they're going to raise that round, because we don't want to be the only players at the table. And I guess lastly, you're seeing an increase in syndication amongst angel groups and seed stage VCs to help facilitate those later rounds.
Well, I'd like to chime in there because it's similar and different. I didn't talk about Clocktower. We invest seed through Series B. So our check ranges from $200K up to $3 million. And you can tell a big difference between when you're investing in a very, very early stage and later stage. For us, KPIs and goals matter way more starting A all the way up. Whereas for us, seed, we are also very, very founder focused. And the way we think about the risk and ability to gain more capital is that, okay, there's, to a certain extent, you can place a bet on the person, and we are all about the person. Even like we push it to the extent that even if we don't think the idea is that great, we want to trust that the person will be able to pivot. And that sounds a little extreme, but we do it. Like, we really bet on the person. And we have our own internal methods of even quantifying like multiple heuristics of a person, like how we think, what their strengths are and they aren't. But the way we think about financing risk is we try to push a person to raise a round that we think, we might be wrong, but we think we'll get them enough money to get to the raise round, to the next round. And if they don't reach that threshold, we don't write the check. So we de-risk from the beginning. We're like, okay, so we want a seed that will have an institutional need at least $1.5 million roughly. And if that person is unable to reach that threshold, we believe they're going to be confronting the need of a bridge or a seed extension. And we don't provide lifelong capital, so we're not able to provide that for them, and we want to make sure that they are correctly positioned to do that. We do help a lot to syndicate around, to meet the right people and put them in front of the right funds that we think will be able to help them with that. So we do our best in that front, but we want to see that part of your ability as an attractor is to reach the amount of capital that we believe is sensible for you to actually reach whatever milestones you think you should reach.
Those are good points. I mean, we've been blessed that we've had 7 A rounds in the last 8 weeks, which is part of the reason why I'm not shaved and look so tired. Is that we spend a lot of time syndicating those rounds. Now, what happened to get to those A rounds were that we picked founders who fit into 2 buckets of 3 questions, and I'm not going to go through the big one that much. But we look for, from 10,000 feet, we look for why you, why now, why us. I'm not going to go into that too much, but why you, credible person to build it, why is now the time for your company to exist, and why are we the best investor for you? That's all. That's what
I've stolen that.
That's what you need to be asking venture funds when you're pitching them for money. Those questions, and answering them as well. But from a 10 feet perspective, we're looking for people who can convince people who can hire, who can leave a really well-paid job at Barclays or JP Morgan or Google or Facebook to come and work for you for pretty much like maybe a quarter of what they used to earn and a little bit of equity. So that ability to convince someone to change their life that much is a major hurdle to jump over, and that shows to me a founder who's able to convince people to join them on their journey. We're looking for people who have got the bravery and courage to ship a MVP, minimal viable product, something which barely works, and that's okay. If it fucks up, it's okay, because that's a great sign that someone's already worked out that it's broken and we can fix it. So I like founders who've got the courage to do that, and then also selling. We like founders who can convince someone to pay for that broken MVP, some sort of SaaS revenue stream. So we invest only in companies that are monetizing through SaaS or some sort of subscription service. But typically, when it comes to fintech companies that we fund, the only fintech company that I funded it because we invest a lot in artificial intelligence and we like giant data sets. And this company was analyzing a data set, was using a data set to underwrite loans that had never been done before. And they were analyzing rental applications to be able to provide short-term loans for your next month's rent. So their challenge, what I loved the courageousness and the kind of like sheer just like ballsiness of it, it's the wrong type of word, is that they were looking to turn subprime customers to make them look more like near-prime customers. And that was a fascinating opportunity for me, and it's all data-driven. I was a data scientist before, so that's what I loved. That's what we focus on. But it varies. We do pre-seed and seed. And pre-seed is more about the founder, right? And then seed now, the goalposts have widened so far now that a seed round for us is now $2 to $4 million on a pre-money of somewhere between like 5 to 10 million. that used to be when I first started out in 2016, that used to be the A rounds. Pre-seed is now less than that, but it's still not much. So it's such a varied market. Sorry.
I would agree with. Sorry. I would agree with all that. But one other thing I'd like to. It's kind of a cliche, but what is the pain point that they're addressing? What is? Do I know people who really hate doing whatever it is this company is going to make easier for people to do? So that's and then.
One thing that hasn't mentioned so far is we invest only in Stanford and Berkeley, so I work from my part in Berkeley and from Stanford. We have a professor on the team, and that shows me that this professor, whoever it is, I know for the research, I read a paper, etc. I know what the research is, I know what they believe in, I know how they feel about it, and I know if Professor X believes in you, you're a good person, and you can have a possibility of the job done. And that's what we look for, the whole thing. So who's the professor behind you, who's the research you're working off of, that's the research project you're working off of, that's important to me and my partner.
So you wouldn't look at anyone from Harvard?
All right, so now we're going to go more into the current world. So recently, some of the hottest things in the fintech space, I would say, would be Facebook, Libra, the Calibra also, a couple weeks ago. So what are your thoughts on some of the action with Facebook coming into the fintech space?
Okay, so my opinion on all the different space, it's important that the mechanism is not solid. I'm from Europe, our banking is solid, more solid here than there, but it's pretty solid. People trust the banks here. Like you were saying, Barclays, Lloyd, CSP, they're not going to win there. They're going to win there until they go out. So that's not, they're not going to lose their money. Same here, FDIC protection. There may be a fraud, but it's a pretty good job of what we try to do, which is keep inflation low and win rate reasonably low, and make sure everyone has a job and your ATM works. That should be a base of all finance. And so beyond that, we look for is again a founder, whether they want to change the world, you want to upend the finance, if you want to do it. So like Coinbase, Bitcoin, we know we around the people made this country solid, made Europe solid, and go around them because you think the Fed is doing wrong the interest rates. It's doing interest rates, yeah. They're doing wrong. They're doing so country. You still have the thing on you. 25%, 20% getting it wrong. So that's our view. And that's next, I guess. Who's next here?
I think Libra is a moonshot idea of Facebook's. And this is just my opinion. I actually haven't read much about it because I just think it's kind of a crazy idea that Facebook could possibly pull off. And when I start seeing them get some traction, maybe I'll focus more on it. But I think a lot of why they're doing this is to enable the whole Facebook story to continue to grow, right? I mean, if you think about it, like, why do they want to get into some sort of currency? I mean, I don't think it's to challenge the conventional notions of like fiat currency or even cryptocurrency. I think they just see that, if you have a universal, I'm trying not to use the word currency, but essentially a universal currency, regardless of where someone lives, regardless of whether they're buying something of tangible value or not, it really simplifies your ability to do things, right? Like, an example is, I don't know if you guys play video games or anything like that, but oftentimes if you play a particular game, that game itself will have a notion of a currency, whether it be a Microsoft coin or whatever. I think they're just trying to create something completely off the grid of traditional currency and just say, hey, if you want to buy that guy's, flower or something like that, or if you want to, praise that guy's photo or something like that, just put a Libra coin to it. And they're trying to see where that's going to go. I don't think they necessarily are trying to take over the world and replace all fiat currencies around the world. I literally think they're just trying to see if this is an interesting tool that could help their users engage with each other in a way that is really novel, because it does have something to do with the ability to buy something that is of value from somebody else without ever touching a dollar, right? Like a person in Africa who's completely not hooked to the U.S. payment rails could theoretically, tip you or like you that you sang a good song and you recorded on it. That's a very interesting thing, right? Even though it doesn't have to do with touching a dollar here or there. I think it has a lot to do. It very much reminds me of like the whole free-to-play movement. In a lot of gaming that you see now, or even advertising online, how a lot of it's essentially free, but you're paying with the currency of your attention, right? That type of stuff.
And Facebook's publicly listed, so they have to experiment to be able to justify what their shareholders are looking for. Like they made a $2 billion investment into virtual reality with Oculus, and that kind of bit them in the arse. So they have to be, they have to be trialing new things. Yeah. Yeah, but I mean, I also think that they're struggling at the moment, and they have a hemorrhaging user base, and they have to find something new. But I mean, compliance will one day come and, again, much like VR, bite them in the arse, and they have to be ready for it, and I don't think they are. It's an experiment.
I know they're not.
Exactly.
And it's a way
Right?
at this point, that's all it is.
It's a test.
But it's not even a test. There's still flaws to the way it's designed that have not been fully solved. It's not a truly centralized system. There's like a lot of fear around banks, like how that's going to compromise compliance, like many other processes that are more money. To me, like it's going to take way longer than they think it's going to take to be implemented, if ever.
Yeah.
It raises a lot of questions around like what if it's a currency that's pegged to any currency. It's not really pegged to it's like it just floats.
Yeah.
So that also has many other implications. Like, are they just trying to create a completely parallel ecosystem of like full-blown transactions across all peers, where you never ever need to like go back to your own currency because it represents any currency that you want it to represent?
But at some point you have to be fiat and get from somewhere, right? I'm paying for you euro or pound.
Right, but that's the whole point, right? Will they ever cash out, or maybe they just won't have the
But
need to?
at some point, if I'm paying rent, my mortgage broker will accept I can leave dollars or euro, whatever the currency is. And somehow convert back to dollars and euros to pay. I need to get groceries or whatever it is.
Well, I mean, I don't know. I think we're trivializing it. I mean, if you think about this whole notion that digital goods have some sort of value, right? I don't know if any of you guys are familiar with CryptoKitties, but it's essentially value associated with pictures of cats. I had to really think about that. But there is value. Some CryptoKitties, some cats are worth, a penny. Some are worth hundreds of thousands of dollars, purely because it was owned by somebody or that someone designed it. I mean, to make the argument that it's got no point because it's not tied to a convertible exchange, you say the same thing about the US dollar.
No,
right?
I'm not saying
It's
that's not the point. It has a point. It could have it could be truly transformative if it happens. It could create a parallel economy.
Yeah.
That's my point.
But that's my point as well, is that the idea is first to create engagement, right? Like if you think about it, the US currency is not tied to anything now either, except the fact that a ton of people use it in the United States, and it's become acceptable tender to buy things like cars and stuff. You start with buying pictures of cats online, right? And then at some point, Facebook's got so many people that they're saying, hey, everyone's using it. And I honestly think they're approaching this in a very smart way. They're just saying, you know what? We don't know if this is going to be a big deal or not, but there's a lot of people. And they might start using it because it is the standard on Facebook to buy pictures of cats. And next thing you know, a picture of a cat is going to be worth enough that you can pay your rent with it. And I honestly think that's how it gets connected. Crazier things have happened on the internet.
I still think it's a long way off.
I think it's a long way up as
I
well.
agree.
But I think there's an underlying principle that I think is more important, because I'm guessing the vast majority of founders in here are more seed stage founders. I'm guessing it's sort of a fair assumption. That the whole notion of going narrow and deep is an important one, regardless of the industry, regardless of the sector. Whether you're doing pictures of cats and you're going to be the best way in which you monetize that, or whether or not, UNES, which a company recently invested in, was streamlining, making the 529 college savings plan process as easy and as fast as possible, which is currently confusing and convoluted for a number of reasons. I think that creating that niche and creating that value and understanding your customer base and focusing on that will allow you the opportunity to expand and be the Facebook cat monetization.
If you want to find another part of the FANG makeup, I'd look at Apple and what they're doing with their credit cards. That to me is exciting and different because they're looking at instantaneous release of rewards and cash that you built up. It's that I like the more subtle, simpler things that are just slightly making a spin on what we currently take as being accepted within financial services today. I'm not sure how well that's going to go. I mean, they're horrendous at software generally, but I think there's something quite cool about their card, and I'm already pre-ordered for it. I don't know how many of you are, but I'm quite excited for that.
We all already use credit cards to buy things, whereas Bitcoin's been around for quite a few years, but still doesn't really get used as a medium of exchange.
Exactly.
Regulatory.
And it doesn't use the whole output of the country of Denmark to be able to run it.
All right, so now we're going to go into even more recent news. So last night, Capital One got hacked, data breach, 100 million users. Prior to that, we had the Marriott breach, 500 million. So these hacks are going to be affecting the fintech space and pretty much, I would say, almost every single industry.
We already have.
Yeah. So what are your thoughts on going on in the future with fintech and cybersecurity now, where this stuff really has to be taken seriously within the fintech space?
Build it into your seed raise.
In terms of cybersecurity, the intent is all wrong. So you take a look at, if one of our investors gets hacked, if one of the big guys, I think who gets hacked, 5 million euros kind of compromise. We can see what we would cool. We can drop the profits, right? And yet, I have to apply for it, get my money back. What they should do is have my investor to get a piece of the settlement and have them say, okay, we have to pay X amount of our users because this happened, or because it happened. And then we'll argue for the rent that's happening, and figure out where we are now. Right now, it's just a band-aid. It's not curing the problem. The problem being, you're building stuff on top of software that no one knows, no one says it, no one in 30 years, no one's gonna look at 30 years, but no one says to do so. I worked with Google for a long time. I know how it works. People stay for the cool unicorn, whether it's Gmail or Android or name your product. They do it and they leave. At this point, they don't even know what was there, what's going on. Take it on the table, bugs are found, and who is we know it existed because now someone else is for it.
Telling you, build it. If you come and pitch me an idea with budget and a part of your raise that is going to go towards a full-time compliance person and a full-time data security person, that really gets my interest.
Yeah,
because why not? This is not. This is not.
There's no why not.
Even at seed stage, this is not a job that you outsource to a lawyer. This is not a job that you outsource to a consultant. You should, if you're raising a seed round, you should expand that round to include 2 full-time people who understand this inside and out and will not leave you open. Because what happened yesterday, that could have been avoided because no one listened or learned from Equifax, and it's super disappointing. And you're all, if you're collecting, I can't tell you how many companies that I've been pitched who keep customer payment information on Google Docs or on Excel sheets that are stored on someone's desktop. I mean, that shit's scary and it's real. Like one of my founders who founded an e-commerce company, which is now crushing it, but his last company failed because someone hacked in and stole all his payment information. That caused him to reset his career by 5 years. This is serious stuff. So if you're thinking about fintech, or again, I'm not an investor in crypto or into blockchain right now, but if you're in fintech, you need to have that in your raise, and you should be paying those people whatever they need.
I agree, but I think that at the seed stage, even if you have a compliance person, depends on and I'm not a technical person, like how much of the tech stack you're willing to build. I think at that early stage, you should think more about setting up the right partnerships with the right banks, the right AML software people who can help you do it, and sometimes at the earlier stage, safeguarding that with people who have done it and have experience is extremely important. And then also I think these data breaches created the landscape for a whole new wave of innovation to come. At the consumer level as well. Like, people are way more aware about their privacy and the information being all over the place than before. And that leads to, for example, like an ability to be able to freeze my credit score everywhere immediately the moment I want to, protect that for my children. I think people are more and more willing to pay for services like this and stop trusting institutions to do it for them, although it's been a long-held assumption that institutions do it for you. It's proven it's not as obvious anymore. But I think people are more willing to take the matters in their own hands and even being willing to spend money to protect themselves. And that could even lead to a rise in insurance services that are focused on this stuff, right? So like all sorts of stuff. I think that can actually lead to real innovation.
I think it comes like in financial services. What I learned when I was an operator was that like customer ownership is everything, right? So if you are originating that lead and you are then selling it to X, or if you are then underwriting a loan off the back of that lead, yes, banking KYC does come in and help mitigate some of that. But if you own that customer, which is where all your enterprise value is generated, then I think you can't outsource that personally.
Well, you can't. You need to outsource a bank if you.
You have to outsource the bank, but
so like that's the time
yeah,
that I meant.
yeah.
Any other input?
The big hacks that we've heard of have been at companies that have been doing that for a long time. So maybe one of the positives of
they're
fintech.
built on top of stuff that no one knows.
So that's where I was going. That when fintech, if a new company starts to do that, right, they're building it from the ground up. They get these old, you get old systems because no one wants to build it from the ground up.
Because they inherit it. There's layers of legacy that they inherit from the last CIO to the last CIO.
As you were saying, I was Berkeley, like you were right.
Yeah.
Our server on crap.
Yeah, we were still running MS DOS at one point.
Of course.
Yeah. Green screen.
Windows 3.1, man.
Yeah.
So
I think there's a little bit of practical advice, like sort of a cross-section between having two compliance people full-time in the seed stage and yeah, it was a little, but
That's why I never raise money for me.
No, I'm not sure, but no, genuinely, I'm not going to call out, I'm not going to look at anyone. There is not a founder, but a founding team member, so someone in the room who's been in that exact situation that you just described, managing information on a Google Doc, and so I've heard of it and I've seen it. But to another point, when you're going about your raise and when you're thinking about, okay, how much do I allocate for a compliance person? How much do I allocate, for my cell phone, which is my daughter. I'm a terrible father right now. Is one rule of thumb, especially regardless of the industry, but especially in fintech, is that there's going to be a moment where shit's going to hit the fan for you. And one thing that you should, will give you credibility when you're in there with, whether it's a seed stage VC or an angel investor, is to allocate at least 20, I would say likely more like 25 or 30% of your raise, and take, say I think I need $1 million in order to hit this next milestone and achieve my A. That's low, obviously, but then make it 1.3 and take that 300K and say, you know what, we're going to put this in a separate account. We're going to allocate this for that moment so that I'm not coming back knocking on your door, investor, and bothering you when the crap inevitably hits the fan. So, and maybe you apply it to a compliance person, or maybe you apply it to developing that right partnership with bank or whatnot, but it's going to happen for 9 times out of 10, it's going to happen. So just trust me on that and raise a little bit more than you think you're going to need.
So last question. So what are some of your future predictions in the fintech landscape, do you think, within the next 1 to 3 years or so, or 1 to 5 years?
Can I keep it rolling? Because I just want to be done talking for a minute. All right. My prediction is that impact is going to play a much larger role in the fintech space. I think that one thing that's true is that if you talk to a millennial, that they care about where their money is going. I just had the opportunity to sit in on a conference with IPI, and there was a woman from Bank of America that I never expect to see. Bank of America, they're presenting essentially their impact funds that they were getting ready to launch. This room of super high net worth individuals, and it was a big wealth transition conference. All these people getting ready to inherit, hundreds of millions of dollars. And where are they going to deploy their funds? She was trying to say, look, you know what, deploy your funds through us because we're creating separate funds dedicated to investing in minority-owned businesses, women-owned businesses. This is a wonderful thing, but you can do good and you can make money at the same time. And there are companies that we've invested in recently, like My C Note, for example. That was, if you have a chance, take a look. I mean, it's not the sexiest product in the world, but it's going back into, it's a way in which you can save your money at a higher interest rate and have the money funneled back into minority-owned, women-owned community businesses, CDFIs. Anyway, I'm going to get long-winded, but I'm happy to talk with you more about how the cross-section of impact in fintech later on.
So just in case some of the people in the video don't know what impact investing is, can you explain a little deeper what is impact investing? There's some newer people here too.
Well, I mean, impact investing in a nutshell is if you're passionate about a certain cause, impact investing is voting with your dollars to whether it's climate change, and you can make money at the end of the day by investing in a solar company that's Tesla, for example. You can make money and support the causes that you care about simultaneously. So there you go.
I'd just like to highlight that the founders of C-Note, Humblister, and Unest are all women. So I think that's pretty cool.
Hello.
All the companies that have been referred today are women.
If you're a smart seed stage investor, you will actually find female-owned fintech companies, especially because they're, unfortunately, they spend your dollars better as an investor. It's been proven, and frankly, the valuations are more attractive still because it's less of a competitive marketplace. It shouldn't be that way. It shouldn't be that way. But I'm just saying, if we're being practical here, it shouldn't be. But I'm just saying that there's a strong argument that they can be made.
Out of those large up rounds I've had in the last 6-8 weeks, half of them were raised by women founders, and they were the biggest markups of my fund.
The reason for, I think, for women is that, or women or minorities, that they've had to do more hoops than someone like me, a Moroccan Jew who went to Eton College and then Stanford. For me, it's easy. I go to Prime Minister and hey, boy, I'm in your school, invest in me. They can't do that.
You went to school with the Royals, man.
That too. I mean, so it's easier with money than someone, I don't know, you guys, you can call it here, but there you go. I mean, it's easier for me with money than most people here. And so, I am thinking a minority. I'm not the kind of person to invest in because, hey, I get someone else, might be higher than yours, but for someone like, not to be racist or anything, but an African who grew up in the hood would be a much better man because you had to work hard to get out of the hood. Anyway, you're paying to me than somebody who went to Eton and then called me up there. I said, I didn't like you did, and they come and talk to me. Much easier to do that than somebody from East Palo Alto to get a Stanford PhD, then comes to me and says, I have an idea, invest in me.
But coming back to your original question on trends, I think that financial services will increasingly be embedded in other services. So in software services or even contextually like payments, I think not a far future, you'll just walk in and out everywhere like Amazon and not pay. So like they're gonna be increasingly mindless, increasingly cheaper, accessible, and people are just gonna be taking it for granted much more, which speaks for much more innovation to take place in many others like industries you wouldn't really consider financial services part.
So my forecast that I'm gonna throw a grenade out there. Okay, so hopefully none of you guys kill me for this later, but I think that any fintech company that's focused on lowering the cost of the product is going to fail. I think ultimately you have to go after true product innovation. You have to come up with a new product, a new actual product or service in order to survive and reach scale. And the examples I give to that, now let me take a step back. Why do I think that's a controversial point? Because all of entrepreneurship is essentially based upon this notion of the entrepreneur's dilemma, right? The entrepreneur's dilemma being that an entrepreneur ultimately has purpose because they are creating something that ultimately lowers the cost to the end consumer. So to the point that it is a commodity, right? So you look at things like Google Maps and what that cycle did, or you look at like how Amazon e-commerce has basically sucked every dollar profit out there, and that's why it succeeds. I think fintech has to play by a very different playbook. You cannot just be the lowest cost provider because a bigger bank with a better brand will come and beat you. And so that applies whenever I look at anything that where an entrepreneur is trying to target a higher APR or a lower transaction fee. To me, those are all going to get replaced by a larger, deeper pocketed, better empowered person, because the innovator's dilemma does not apply to fintech. You ultimately have to come up with something different, a different way of packaging data like Mint, or a different potential payment network like Brex, right? That I don't know if you guys have seen this, but it's a essentially a credit system for the unbanked, right? Except for commercial businesses and things like that. I think you can't just be cheaper. You can't, I would argue you can't just go after a certain demographic either. I personally think the Acorns of the world have a limited shelf life, that ultimately someone bigger and better with more resources will figure out how to go after, lower income people in the investing world. It's why ShareBuilder ultimately did not succeed, all those things. So that's my
I like companies that are screwing with actuaries, because I think that we are underwriting loans and making credit decisions and deciding who's eligible for a checking account based upon metrics that are quasi 100 years old. I think there are people who are using different data sets to be able to make decisions, financial decisions, that will improve the financial health of people who are unbanked, and also create entirely new product classes that never existed before. So I'm an AI investor, that's what most of my portfolio is, but I love giant data sets that turn things on its head. I mean, I genuinely regard people who work solely with zeros and ones as probably being redundant in the next 15 years. That includes accountants, that includes actuaries, that includes a whole portion of the banking system that will be gone because of the predictions that AI can make and does make today. So that's why I'm interested in. I can't tell you how many banks I've seen for creatives and for artists and for actors and for musicians. That's got no traction for me. I just like people who are just doing really cool shit with data and changing mindsets.
Speaking of trends in big data, I'd say increased automation of the financial markets. It's been happening. Most equity trades now are done by computers. It's moving towards fixed income. There's so much information out there. It's easily digitally accessible now. There's no way that the old style of looking at price to earnings ratios and things like that is going to cut it. You're going to have to incorporate all that information, and that'll be a big area where people will be employed and some people will not be employed.
And why do you pay a wealth manager 130 basis points to do what an ETF will do for 30 basis points? So, whatever.
Yeah,
but I'm saying that majority of a true RIA's time is spent on relationship development and sales, which is a CRM job, not underwriting and not making decisions. So at least for myself, I would not pay someone 130 basis points to put me in a S&P 500 index. That's just not interesting to me. I will pay someone who put me into 15 concentrated stocks that they have been monitoring for X period of time, and they have a very tight focus on. And in fact, I have done. That's what my only wealth management is within a value investor. I will not give money to a large shop anymore because why?
And as you can pay that 130 basis points or more for someone who's just better at incorporating the information.
Yeah, I'll put it back in my own fund. Yeah.
Exactly. Any other future projections? All right, so one more last one. Any questions from the audience here?
Thanks, Jeff. All right, so you guys are obviously Oh, sorry, because we're recording. You guys are experts in the fintech space. How do you see blockchain and cryptocurrencies affecting the future? We talked about Libra. That's not a real one, but cryptocurrencies as a whole.
Well, as I was saying,
Well, we had a private conversation. You don't have to tell everybody about that.
Even before I was saying, before this, I come from the banking world like this and that I do. And I think that in the West, Europe and the US for the most part, the finance is actually pretty good. The way the Fed's not perfect, the ECB's not perfect, but they did a pretty good job. Everyone's low, it get pretty low. Not perfect, but it's kept in a pretty good job of it and built trust in. In place 11, when my mom was born, may have a bigger impact. But with year 11, or year Europe, nothing. And therefore, it's a tough ask. Maybe 5 years now. People are maybe 5 years, maybe 50 years. I'm 4 years old now. I mean, I ain't 50 years now.
Yeah, it's hard to predict the future.
Probably dead, so.
Makes sense.
Any other questions?
Just an easy one. How do you quantify traction in the fintech world? Just in general, not looking for a number, but something that would be close to a number would be great.
You know, I think that's a dangerous question to ask. There are, thankfully, a lot of different ways now. I mean, I think, you know, the job of most venture capitalists is really a game of pattern recognition, right? So, you know, I mean, I think there's classical thinking, and then there's going to be slightly more innovative thinking, right? Classical models have a lot to do with data, right? So for most fintech companies, I think you can rely on some sort of cohort-based performance trends. And so what that means is you take all your users and you put them in monthly buckets, usually anchored around a single trigger action, right? So like, let's say these are all the people that first used my product January 2010, right? And you look at how those groups perform. If you're focused on underwriting, you see how that cohort performed relative to, let's say, a traditional underwriting method, right? If, let's say, you're buying a home and it's based upon some notion, some percentage of your income or something like that. And you look at how the different methods, right? Different methods for banked, unbanked, all these different people and how they perform. That's the simple way. I think some of the more innovative ways are created by necessity. They are based around ideas that really haven't come out yet. In the enterprise world, I think fintech borrows a lot from the enterprise world. You look at things like traditional SaaS economics, right? Whether there is a payback on the average contract values, whether they're increasing or whether there's this notion of negative loss, meaning if a person comes in paying $100 a month or something, you can actually have negative loss if over a year's time that person's actually paying $130 for what you have. In other words, there is a negative loss, right? And a classic example of that is something like Salesforce, or a bank account that actually increases in balance over time. So there's a lot of common sense metrics that I think you can apply, and a lot of it, honestly, is just tied to the drivers of business.
MAUs, delinquency rates, premium rates, loss ratios, the standard things that we look at when you're running a bank are also very appropriate to when you're building a fintech company. But like I said, I agree. SaaS metrics are important, but don't forget the core of running a financial company.
And by the way, I think the metrics are going to be different for different stages, right? So it can be sliced in a billion different ways.
I want to know how many referrals are coming up from each user and how actively they're engaged with whatever it is you're doing. I mean, if you have users that love what you're doing early on and they're sharing it, then no matter how smart I think I am, if I disagree with you, I'm going to take some time to listen to what you're up to.
So
So like one more last question, right there.
Sure.
Yeah.
Great. So if you're a founder in fintech, why be here in LA, not New York, not SF, not London?
I love your question.
Yeah.
Everyone should live in LA, period.
Well, I agree, but what's your
Well,
answer?
did you read the news? Actually, for example, we were just talking about this. Monzo started their US subsidiary in LA.
Monster, you said? Or
Monzo.
Monzo.
They're one of the biggest UK banks, and and we love founders who are in LA. There's great talent from great schools, lower cost of living that allows you to make way more with your money. Very close to SF if you need to be. I think that helps. Like you can raise money from VCs, but you can also start building your own ecosystem here. And I just love LA a lot.
I flew down this morning from SF, like, yeah, close to that part. It's not to sound. It's much easier for me to drive to San Menlo Park and get meet everyone, A16Z, whomever else, Sequoia, whoever else is down there, than it is for you guys to fly up from here, Burbank, to San Jose, get traffic done, do that, I need to Menlo Park. Better for me to go down to Tiburon, wherever I am, to get to Menlo Park and meet Jason Calacanis, whomever I meet. And either meet these people socially and other things, where I get the business card, you know, speed dial, then I can meet you guys, meet someone down here, hey, Jason, help me this guy. And he may do it, but he already do it by calling him versus someone cold calls him. Or get that party.
I think geography should be the last thing you think about when basing your company. Because it doesn't matter. Like today, you know, Zoom has democratized the ability to have group team meetings, right? You know, London, yes, is important, but after Brexit, that might change quite a lot. Let's just be honest about that. Also, LA is not got a big financial hub here. I mean, there is some. There's lots of PE and lots of banks based here for the Pacific Rim and stuff. But you know, if I was to be betting on things in the future, I'd be looking at digital native communities like in Africa. I'd be, as weird as it sounds, I think the next financial capital in the world will be Nairobi.
I'll challenge you in Uruguay.
Go ahead. But I find that, you know, countries and communities of people that are banking entirely digitally are the pathway to the future, and I'm not sure that the US is quite poised for that, and I certainly don't. Actually, England's not doing bad, and I'm biased, but I don't think you can be constrained by that. And to base your operation on where you should be is the worst decision you can make. It should be where you can learn the most, you can hire the best talent.
Which is closest to your customers.
Yeah.
Live closest to wherever your core customer base is, regardless of what you're doing. I mean, it's sort of, I don't know if you could, but just seriously, if you think where did you? I didn't even hear you.
I live there, Uruguay. They have a policy where they give you, well, it's not important.
Yeah, anyway, go live there.
Why not? You have a great
Why not live in both? I live in both.
There's incredible developers in Central and South America. Why not?
Yeah. My next question was, if what you're saying.
I'll give you one question. That's all right.
Yeah.
So
wait, Dave. You have an answer?
I honestly think it does matter, but I don't think I can give a universal response to it, because honestly it depends on what your company is doing, what the circumstances are, but I do believe for every type of company there is kind of a best place to start it, for some of the reasons that people brought up, but you know, you should think about what you need to reach the next milestone or the future milestones of success. You know, location matters because certain investors are concentrated in certain areas. Certain types of talent are better in certain areas than others. Frankly, I'll be very honest with you, like in the top 6 markets where venture and startup is the strongest in America, the work ethics of the people in each of those cities dramatically different. I mean, when you talk about entitlement versus long hours, you know, I'm thinking New York, versus whatever, the productivity that you get out of an engineer or a non-technical person is completely different in each one of those cities.
I don't think you can stereotype on cities.
You can't because you're doing it. Then we all do that.
I don't know.
You're in LA, right?
I know lots of lazy people in London.
Only
and
British.
I know lots of hardworking people here and in Monterrey, Mexico.
Sure.
Right, so
But let's really dig into that, right? I'm not focusing on specifics, right? I'm saying there are a lot of people who love fintech in New York. There's more than they are in LA. Okay, just because of how that city is driven off of Wall Street, and I think it's just easier to get things done there. You know, like I've had 5 startups, okay, in LA, and I can tell you that there were things that were so much easier to get done. If I want an e-commerce guy, LA is a great city for an e-commerce guy. Lately, that's changed a bit because LA gets that home court advantage of being kind of a nice place to live, and so you get a lot of people who come down, right? Guys like Founders Fund, right? Who would come down to LA, right? All these people. Elon Musk, right? Look at Elon Musk. I mean, people come to LA. You do get a lot of imports, but I think there are certain trends in terms of people's mentalities that are different. I mean, you go talk to an engineer in the Bay Area, they will tell you that they work during certain hours, and you gotta leave me alone during the others because I'm on my 20% schedule or something like that. Whereas I find it to be very, very different in other markets. New York, I can call an engineer at 10 p.m. at night and be like, why are you still on the phone? And it's just a different, I mean, the cities just work with a different level of energy. I find that to be the case in my career. So.
Can I do one more question?
No. So, all right, thanks a lot for being here tonight. And you can ask questions after. Always got to keep in mindful of their time too.
Sure.
So thanks a lot, everyone.